Welcome to the Beginner's Guide on Stocks and Bonds. Today, I will share two key building blocks of investing that can help you grow your wealth over time. Whether you're just starting out or looking to understand these financial instruments better, we've got you covered. What are stocks? Let's begin with stocks. When you buy a stock, you are essentially purchasing a small piece of ownership in a company. This piece of ownership is called a share. Companies issue stocks to raise capital. In return, investors, like you, become shareholders. As a shareholder, you have a stake in the company's performance. If the company grows and becomes more profitable, the value of your shares can go up. But remember, the value of stocks can also decrease if the company faces challenges or loses value in the market. How do you make money from stocks? There are two main ways you can make money from stocks. First, through capital appreciation, which means selling your shares at a higher price than what you paid for them. Second, through dividends. Some companies pay out a portion of their earnings to shareholders as dividends, offering you a steady income stream. However, stocks are more volatile than some other investments. Their prices can go up and down frequently, so it's important to invest with a long-term mindset. What are bonds? Now let's talk about bonds. Bonds are essentially loans that you, the investor, give to governments, corporations, or other organizations. In return for your loan, the issuer promises to pay you back with interest over a fixed period. Bonds are generally considered less risky than stocks. They provide regular income through interest payments, which are usually fixed, and the return of the principal amount at the bond's maturity date. Types of bonds. There are different types of bonds, such as government bonds, which are issued by national governments and considered very safe. Then there are corporate bonds, which are riskier but can offer higher returns, and municipal bonds, issued by local governments, often with tax benefits. How do you make money from bonds? You make money from bonds in two ways. First, through interest payments you receive regularly, and second, by receiving your initial investment back when the bond matures. Bonds tend to be more stable than stocks, but their returns are generally lower. They're often used as a way to balance risk in an investment portfolio. Stocks versus bonds. So, what's the difference between stocks and bonds? Stocks represent ownership in a company, and they can grow in value or decline based on the company's performance. They're riskier but have the potential for higher returns. Bonds, on the other hand, are loans that offer steady income through interest, with less risk but generally lower returns. Both play important roles in a diversified investment portfolio. Which is right for you? Which should you invest in, stocks or bonds? That depends on your financial goals, risk tolerance, and time horizon. If you're young and can handle more risk, stocks might offer the growth potential you need. If you're looking for steady income and lower risk, bonds might be a better fit. Diversification. The power of both. Many investors use a combination of both stocks and bonds to build a diversified portfolio. This way, you can enjoy the growth potential of stocks while balancing it with the stability of bonds. Diversification helps manage risk while aiming for steady returns over time. Final thoughts. Stocks and bonds are the foundation of most investment portfolios. By understanding how they work, you can make informed decisions to grow your wealth and reach your financial goals. Thank you for watching. If you found this helpful, make sure to subscribe and stay tuned for more tips on investing, financial planning, and how to build a strong portfolio. See you in the next video.